All right, here's the balance sheet, and if I make it a little bit bigger, it's probably easier for you to see. And we're not going to do a lot here, but again, what we see is we have the asset side of the balance sheet, and we have the liability side of the balance sheet. And what I like to do is let's sort of think about this is which items here are decision variables, which ones tend to be percentages of sales or something else like that. Cash depends. Cash is sort of one of those things which I want to write on this, which sort of I'm not really sure. It could be percent of sales in the following sense that what I really want the cash to be in the firm is the operating cash. How much cash does the firm need to operate? Not just how much cash it has, but tends to how much cash it needs to just operate. And so cash and cash equivalents, this could be actually a combination of actually cash in the bank plus some marketable securities. And we'll talk a little bit more about that later. Accounts receivable, as we've talked about before, this would be what people owe, what the customers owe Target. And so in this one, we would expect this. The more you sell, accounts receivable should go up. The more people are going to. So we would really expect this to be a percentage of sales. And the receivables are based upon the price at which it's sold to the customers, and so a percentage of sale. Inventory. Now, inventory, typically, we could do inventory as a percentage of sales. We could. A better way is to think about inventory as a percentage of cost of goods sold. Okay, and as I point out in the tutorial, that basically inventory is carried at the cost of what it was to produce it or purchase it. So it's a cost base. So inventory tends to be cost based. And as such, a better relationship, a better measure of its relationship is as a percentage of cost of goods sold. Okay, and just sort of put that. Deferred income taxes, that's sort of, I'm not sure. Other current assets, it's not, I'm not sure, percent of sales. We'll have to look at that. Again, that sort of depends on what's in there, and it's not clear what is in fact in there. The other thing we look at is sort of net fixed assets. Net fixed assets, if we look at net fixed assets, we can observe that it goes up as sales go up. So if sales go up, we see that the net fixed assets are going to go up. And basically, so we're going to assume that net fixed assets for somebody like Target is probably pretty well expressed as a percentage of sales. And the reason that that would make sense is they grow by building more stores. So if they're going to grow, basically what they're going to have to do is build more stores. Now, the sales grow two ways, as we see when we go through this. One is through new stores being built, and then there's also the benefit of increases in sales in the stores you already have built. And so there's a distinction there, but basically we would expect that for sales to increase for somebody like Target, they have to build more stores. So therefore we'd expect net fixed assets to increase with that. All right. We have cost in excess, and that's sort of related to purchases that the acquisitions they may have made. And then we have other non-current assets, and that sort of increases, but as it increases, and I'm not sure that it is a percentage of sales, but clearly it's going up as sales go up. Accounts payable. Accounts payable we're going to express as a percent of cost of goods sold. The reason here is, again, this is what we owe our suppliers. So when we look at accounts payable, it's what we owe our suppliers, and the amount that we owe them is based upon what the purchase price was, not the sales price, but the purchase price of those materials. So again, it's sort of accounts payable is cost-based. So it's a good idea to express it as a percentage of cost of goods sold. Short-term debt is clearly a decision variable on the part of the firm. Okay, that's clearly a decision because they'd actually issue more debt or actually pay back debt. Accrued liabilities, I'm not sure that this is a good way to express it as a percent of sales. We'll have to sort of decide that and where we're going forward, because it's not clearly just looking at the numbers. That's not the case. Other current liabilities, probably not percent of sales, just sort of looking at them for the last few years. Long-term debt, that's a decision variable. And when I say the decision variable, what I mean is that the firm itself is the one who has to make a decision about what's going to happen with long-term debt. It's not going to change automatically with sales. So then we go down here in deferred income taxes. I'm not sure as a percent of sales. Just looking at these numbers, I'm not sure, but we'll look at it. Other non-current liabilities, that's a question mark. Percent sales. That's a question mark in my mind. Okay, when we get down to this, what I want you to look at is we'll start with common par and additional paid-in capital. When a firm issues stock, when it sells stock, two things happen. One, the stock it sells as a piece of paper, and historically will have a par value, and the par value could typically be $1. So the par value of the share of stock is one value, but it turns out that they sell the shares to new investors for $20 per share. And so what would happen is, $1 would go into par value for each share sold, and $19 would go into this additional paid-in capital. So when they sell one share of stock, the par value goes up by whatever the par value was, and additional paid-in capital goes in at the amount that they received over and above the par value for doing it. Now, this is only going to change if they decide to issue. Okay, this is only going to change if they decide actually to issue more shares. So we're going to sort of have to. That's going to be a decision variable. It's not going to change automatically with sales. Retained earnings. Retained earnings is basically will change, but there's a little bit of a decision here in the sense that it's going to depend upon what net income, which is related to sales, but also depends upon what the dividends are, because when we go back and we look at the income statement over here, what we see is that there's additions to retained earnings, which is net income minus dividends, and that gets us our additions. This is the amount of money that's being retained in the firm. So when we go back over here, when we do our forecast, the retained earnings, and again I have to go back and adjust my pen, the retained earnings are going to be last year's retained earnings plus current year additions to retained earnings. And then we go down here, and these sort of other things, this is sort of would be a decision variable. I'm not really even sure what's in there, but it's a decision variable of the firm. We have the total thing. And again, each year, assets and liabilities have to sort of be equal. So that's one of the things that's going to be determined when we start doing the forecast. Okay, so what we've done is we looked at the income statement, and what I've done is walked you through which ones are most likely to be expressed as a percentage of sales, and the items that are decision variables. And then when we look at the balance sheet, we see that there's a number of items which are clearly percentages of sales or percentages of cost of goods sold, and ones that I have question marks about. Should they be expressed as percentage of sales? And then I've identified all the different ones which I think are decision variables, where actually not going to change automatically with a change in sales. Okay, so I think that taking a few minutes, let me suggest that taking a few minutes before you jump into the forecast with Excel and everything else like that, we're forecasting for taking a few minutes and do what we just did by walking through and sort of saying, well, these are clearly percentages of sales. These are decision variables. I'm not really sure if these look like their percentage of sales. So let's sort of think about what these sort of implications are and that'll come up when we start doing the forecast. Okay, so with this introduction, I'm just going to close this section. And what I'm going to do is we're going to start with the next section on the forecast of the income statement. Okay.